Welcome to Stock Investing for Beginners. In this course, you'll embark on a journey designed to understand and profit from the stock market. We'll strip away the noise and focus only on fundamentals, real financial statements, real value metrics. By the end of this course, you'll be able to build your first basic discounted cash flow model, interpret the most important ratios on a company's balance sheet, and put together a simple yet diversified U.S. stock portfolio. Our learning path is deliberately sequential to help you build confidence at each step. We start with how the U.S. market works, order types, trading sessions, and who's who on the tape. Then we dive into the three core financial statements and footnotes before tackling valuation methods like PE, EV/EBITDA, and DCF projections. Next, we assess risk, screen for top candidates, and finally assemble your portfolio with beginner-level position, sizing, and diversification best practices. Every lesson is delivered as crisp, slides-only content, so you stay focused, not distracted. If you prefer to focus on one area, feel free to jump directly to any chapter as your personal area of mastery. Welcome to the U.S. stock market's blueprint. You'll see how buyers and sellers converge on platforms like the NYSE or NASDAQ. By splitting the day into pre-market, regular, and after-hour sessions, these exchanges ensure there's always a place to find or place liquidity. Think of them as the heartbeat of trading. Without them, price discovery simply wouldn't happen. Market makers are the behind-the-scenes heroes that keep trades flowing. Firms such as Citadel and Virtu stand ready to buy or sell at quoted prices, and they earn their keep by pocketing the spread between those prices. Next time you check a quote, remember someone on the other side is committing capital to take your order. On the retail side, everyday investors like you route orders through brokers. These orders tend to be smaller, so execution priority can differ from big institutional trades. Some brokers route orders based on payment for order flow agreements, meaning your trade might first land with a specific market maker. That nuance can subtly influence the price you get. Institutional investors, think pension funds and mutual funds, move massive blocks of shares. To avoid shocking the market price, they often use dark pools, which are private venues invisible to the wider market. When they rebalance portfolios, entire sectors can swing, so spotting these flows can give you an edge on timing. Liquidity is all about order flow, the stream of buys and sells hitting the book. When volume is high, spreads tighten and you get better fills. But trade around earnings or major news, and you might see a flurry of volume followed by a sudden dry up, risking slippage. Always check recent volume before you commit capital. The bid-ask spread is your immediate trading cost. A 2-cent spread on Apple feels tiny. A 50-cent spread on a small-cap biotech can eat your profits. Market makers widen spreads when volatility spikes or risk rises. By focusing on liquid names during active hours, you can keep your trading costs low. Not all trading happens on big exchanges. Over-the-counter, OTC, markets handle smaller or unlisted securities through dealer networks. OTC venues can save you when stocks aren't exchange-listed, but they come with greater counterparty and information risk. Always know where your order lands before you hit buy. Ultimately, understanding who's trading and where gives you real power. If you know market makers pull back in low liquidity stretches, you can avoid wide spreads. If institutional rebalances are looming, you can time entries or exits. By aligning your strategy with these participants' behaviors, you'll execute smarter and cost-effectively. Think of order types as the tools in your trading toolbox. You have market orders for speed, limit orders for price control, and a handful of specialized orders for specific needs. By matching each tool to your goal, whether that's locking in a price or exiting fast, you'll avoid the frustration of unexpected fills or missed opportunities. When you place a market order, you're saying, just get me in or out right now. That's great for blue chips like Apple or Microsoft where liquidity is deep. But if you try it on a thin biotech stock after hours, you might end up paying significantly more or selling for much less than you expected. Limit orders give you certainty. You only buy at or below your price, and you only sell at or above it. Imagine you want to buy Tesla, but only if it dips to $650. A limit order sits patiently until the market cooperates, or expires unfilled if it never hits that level. Stop orders can be your automated safety net. For example, if you own shares of volatile tech startup, you might set a stop at 10% below today's close. That turns into a market order if triggered, fast, but potentially at a worse price. A stop limit order adds a price floor, so you don't get stopped out at a drastic price. Fill or kill and all or none orders sound fancy, but they're simply about avoiding partial fills. If you need exactly 5,000 shares for a small cap ETF, an AON order will rest until it can fill completely. If it can't, it stays unfilled, protecting you from being stuck with half your position. Not all venues are created equal. Your broker might send your order to the NYSE, an ECN like ARCA, or even a dark pool. Each has its own speed, fees, and displayed liquidity. Ask your broker where they route orders and why. It can shave a few pennies off your cost over time. Lippage and partial fills are the silent killers of trading profits. Picture placing a market order on a volatile small cap stock. You see $10, but you get filled at $10.25. That 25-cent slip hurts your returns. By checking average trade size and current spreads before ordering, you can pull back or switch to a limit order. Treat every trade like a mini project. Verify your order type, quantity, and desired price. After the trade, review your execution report. Did you get the price you expected? If not, tweak your checklist. Over time, that simple habit will save you frustration and real dollars. You're about to tap into the heartbeat of real-time trading. Level 2 in the tape. Level 2 shows every bid and ask sitting in the queue, while the tape logs each trade as it happens. Together, they let you see exactly how much supply and demand is waiting and how fast it's being consumed. Insights you can't get from a simple price chart alone. Think of the order book as a waiting room. Bids on the left, asks on the right, each with its head count. When one side grows much larger, it starts acting like a magnet or a wall. You learn to watch those crowd sizes to judge whether a price will stick or break through. Depth of market, or DOM, is your crowd gauge. If only a handful of shares sit near the best bid, that stock can move 2 or 3 ticks on a single trade. But if there are thousands of shares stacked, you can trade more confidently without shifting the price. Order book imbalances are like traffic jams. If a highway lane suddenly holds 10 times more cars than the other, you know which side is clogged. Similarly, a lopsided book can tip you off that one side's about to give in or hold firm. Key for short-term entries. Now, the tape, the real-time log of every fill. When you see prints hitting the ask price, that's buyers eating up sellers' quotes, bullish aggression. Prints at the bid mean sellers are forcing buyers to take their price, bearish. That nuance helps you confirm what the book is telling you. Not all orders show their full size. Icebergs hide big volume by only displaying a small slice. When that slice refills repeatedly, you know there's more behind it. Spotting icebergs prevents you from stumbling into a bigger counterorder than you bargained for. Timing is everything. When you see aggressive tape prints at the ask and bids holding strong, you can lean in with confidence. If the bids evaporate or a flood of asks appears, it's time to lock in profits. And always start with a small pilot order. Test the water before diving in. Finally, guard against common traps. Don't chase every big print. Look for consistent patterns. Be wary of spoofing, where someone places large orders they cancel to mislead. Stick to conservative sizing until you master the flow, and always validate level 2 clues with price action on your chart. And now, to the anatomy of a trading day. You'll see the market's 3 sessions, pre-market, regular, and after hours, each with its own start and end times. By knowing these windows, you can plan when to place your orders and when to step back. Building on that, the pre-market session from 4 a.m. to 9:30 a.m. Eastern is like the market's warm-up. Volume is lower, spreads are wider, and big institutions often react to overnight news. If you jump in here, be prepared for volatile swings and execution challenges. Moving into the regular session, 9:30 a.m. to 4 p.m. Eastern, you hit the market's peak. Tight spreads and high volume mean you get cleaner fills. Keep in mind that major economic reports drop at 8:30 a.m., and volume explosions happen right after the open and just before the close. Continuing to after-hours trading, from 4 p.m. to 8 p.m. Eastern, you get another chance to react to earnings or news released after the bell. But watch out. Liquidity is thin, and spreads can blow out, making costs much higher than during the regular session. Because of thin liquidity, you'll see the biggest price swings in the pre-market and after-hour sessions. During the regular session, volatility spikes right at the open and close. By tracking these patterns, you can pick the right window for entering or exiting your positions. Next, consider how session-driven liquidity affects your orders. In low-volume periods, market orders can suffer severe slippage. Instead, use limit orders to lock in your desired price. And remember, some platforms let you flag orders to stay in session, preventing them from jumping into the next trading window. Now, let's tie it to strategy. If you're just starting out, stick to the regular session when liquidity is healthiest. If you want to react quickly to breaking news in the pre-market, set tight limit orders on highly traded names. And unless you have a strong thesis backed by news, avoid speculating on thinly traded stocks after hours. In summary, each session offers its own playbook. Match your trade size and order type to session liquidity, plan around volatility peaks, and check your simple session awareness checklist before every trade. This disciplined approach helps you navigate the market day with confidence. You're looking at the income statement, your roadmap from sales to profit. Think of it as the company's report card each quarter. Revenue at the top, expenses in the middle, and net profit or loss at the bottom. Those numbers power every metric you'll use, like net margin and earnings per share. So understanding this flow is step one. GAAP stands for Generally Accepted Accounting Principles, standard rules set by the SEC. Non-GAAP, by contrast, is management's custom version, stripping out items they call one-time or non-cash. As an investor, you need to know which version you're valuing. Are you buying the raw accounting or the polished story? Common adjustments include stock-based compensation, when employees get paid in shares, and restructuring charges, like plant closures or layoffs. Companies also back out amortization of intangibles and big legal settlements. These can legitimately mask one-offs, but only if they truly are one-time. They report non-GAAP to show a normalized profit trend and align with their internal goals. It's marketing, too. Smoother growth looks better to analysts. But don't let slick charts distract you. Sometimes management leans too hard on adjustments to manage expectations. Consider Company X. On GAAP, it posts $100 million EBITDA, but it excludes $20 million in stock-based comp and $10 million in severance, claiming a $130 million non-GAAP number. Before you cheer that boost, ask, was that severance really non-recurring, or is it part of ongoing cost-cutting? To spot red flags, dive into the reconciliation tables in the earnings release. If they keep excluding the same one-time cost quarter after quarter, it's not one time. Also, if adjusted metrics are growing faster than GAAP ones, that gap is a warning alarm. In valuations, non-GAAP EBITDA often yields cheaper-looking EV/EBITDA multiples. Adjusted EPS can make P/ES look attractive. But a robust model runs both GAAP and non-GAAP scenarios side by side and tests sensitivity around those adjustments, so you know how much risk you're really taking. Your takeaway: always pull out the bridge from GAAP to non-GAAP. Question every one-time, label, and model both worlds. At the end of the day, focus on actual cash flow conversion, because that's what truly drives shareholder value. You're about to unlock why cash flow matters more than just profits. The cash flow statement shows every dollar moving through the company, unlike the income statement, which can hide non-cash quirks. When you read cash flow, you see the true liquidity picture. Know this, and you'll never be surprised by a cash crunch. Operating cash flow starts from net income, but adds back things like depreciation, expenses on paper, but not in the bank. You also adjust for changes in receivables and payables. If receivables jump, cash is tied up in invoices. If payables rise, the company is holding on to cash longer. That's your day-to-day business heartbeat. Investing cash flow shows where a company plows money into growth, like buying machinery or software. A negative balance isn't bad if it fuels expansion, but huge, unprofitable capex could be a red flag. Check asset sales too. A one-off equipment sale can temporarily pad cash, but it won't last. Financing cash flow tells you how the company pays its bills. Are they taking on debt? Paying it down? Returning cash to shareholders via dividends or buybacks. Watch interest expense trends. Rising debt payments can squeeze margins quickly, especially if revenue growth stalls. Free cash flow, your golden metric. Subtract capex from operating cash flow, and what's left is genuine surplus cash. Positive FCF means the business throws off cash beyond what it needs to maintain operations. That's what you use in DCF valuations, so track it religiously. Free cash flow pockets emerge when a company consistently generates excess cash. Look for steady FCF growth over several years. Then compare to peers. If Techco's FCF margin is 20% and rivals are at 10%, you know Techco has an edge. That surplus funds dividends, buybacks, or debt payoff. Real value back to shareholders. Trends give clues to the company's life cycle. Plot CapEx as a percentage of revenue. Spikes could mean new plants or R&D cycles. Dips might show maturity or underinvestment. Align these patterns with sales growth. If revenue slows but CapEx stays high, something's off. Let's take Techco as an example. After automating its factories, operating cash flow jumped 40% in year 2. CapEx peaked as installations wrapped up, then normalized. By year 3, free cash flow turned positive and management bought back 5% of shares, boosting intrinsic value for long-term holders. That's the power of cash flow analysis in action. When you open a company's balance sheet, think of it like a health check at a doctor's office. You see what the company owns, what it owes, and the capital its owners have put in. You'll use that snapshot to judge whether the business can keep growing or if it's vulnerable when storms hit. Let's talk liquidity. The current ratio tells you if there's enough short-term assets, like cash and receivables, to cover bills coming due. The quick ratio is the same, but more conservative. It ignores inventory, since that can take time to turn into cash. If both ratios stay above 1, you know the firm can meet its obligations. Next, you measure leverage. Total debt shows all the money a company has borrowed. Divide it by equity to get the debt-to-equity ratio. This tells you how much is funded by creditors versus owners. And don't forget the interest coverage ratio. If operating earnings can't cover interest payments, you've got a red flag. Debt isn't all about size. Timing matters too. Check the maturity schedule. If a big chunk of debt comes due next year, that could crash cash reserves. Covenants add another layer. Break those rules, like cutting dividends or taking on more loans, and you could trigger penalties or force repayment. Working capital is your day-to-day lifeline. It's current assets minus current liabilities. Positive working capital means the company can fund operations without scrambling for cash. But in some businesses like subscription services, negative working capital can actually reflect efficient, prepaid revenue. Balance sheets list both tangible and intangible assets. Cash and property are easy to value, but goodwill or patents, those carry judgment calls. If goodwill is a big chunk of equity, stress test it. What happens if the company needs to write down that value after an acquisition goes sour? Shareholders' equity is the safety net. Assets left over after you pay everyone else. Book value per share gives you a rough liquidation floor. If the market price is way above book value, investors are paying for future growth. If it's below, you might be looking at a bargain or a deeper problem. Let's apply these checks to XYZ Corporation. Over 2 years, its current ratio climbed from 1.1 to 1.8, an immediate boost to its liquidity profile. After raising fresh equity, its debt-to-equity ratio halved, cutting leverage risk. Even a recent goodwill impairment didn't breach any covenants. With positive working capital and spread-out maturities, XYZ's balance sheet shows real improvement. And that's what you want to spot before you dive into a company's numbers. You're only seeing half the story. Footnotes and the MD&A fill in the gaps by explaining how those numbers came to be, what assumptions management used, and which items you should treat as one-offs. In short, they turn raw data into actionable insights. Every annual report follows a familiar layout. Look just after the balance sheet and income statement for numbered footnotes. They're your roadmap to detailed disclosures. And flip to the management's discussion and analysis up front for management's own commentary. A quick scan of the index will get you there in seconds. Not all line item hits are created equal. When you see a restructuring or impairment footnote, tag those costs as non-recurring. For example, Company X took a $50 million facility closure charge last year. Don't let that drag down your view of its underlying profitability. Segment disclosures let you dissect where the real profits live. If a tech company splits hardware and services, compare each division's margins. You might find services growing at 20% margin while hardware lags. Insights like these guide where you focus your valuation model. Debt footnotes are your early warning system. They spell out every loan, rate, and when it's due. Pay special attention to covenant terms. If a minimum coverage ratio is set to drop below threshold next year, you'll know a refinancing crunch could be around the corner. Contingent liabilities hide in plain sight. A pending lawsuit footnote might estimate a $100 million payout. If that actually hits, it will siphon cash from operations. Always size these risks and bake them into your downside scenarios. In MD&A, management narrates the story behind the numbers. They'll highlight why revenues jumped or warn of headwinds ahead. Note the language. Confident, cautious, or defensive tones can clue you into how they really see the business evolving. Finally, merge what you learned from footnotes and MD&A into your analysis. Strip out non-recurring hits, weight your forecast by segment performance, and schedule debt maturities alongside your cash flows. By doing so, you'll build a valuation model that's grounded in reality, not just headline figures. You see the P/E ratio everywhere because it's the simplest way to size up a stock's valuation. Think of it like a price tag on each dollar of earnings. If a company trades at a P/E of 20, you're paying $20 for every $1 they earned last year. That gives you a quick sense of whether it feels expensive or cheap compared to similar firms. Trailing P/E looks backward at real earnings from the last 4 quarters. It's solid because it's based on audited numbers. But in fast-moving industries, those numbers can quickly feel stale, like driving while looking in the rearview mirror. You're safe, but you might miss what's coming around the corner. Forward P/E flips that around by using analysts' estimates for next year. It's forward-looking, which can capture expected growth. But remember, it's only as reliable as those forecasts. If guidance shifts or analysts miss the mark, your P/E can jump or tank overnight. Normalized P/E smooths out the bumps by averaging earnings over several years. Imagine you're evaluating a steelmaker. Earnings will spike in boom times and crash in recessions. A multi-year average helps you see its longer-term earning power, rather than betting on a single good or bad quarter. Don't compare apples to oranges. Tech companies often sport P/ES of 30 or 40, while utilities sit around 10 or 12. By sticking to your sector's typical range, you avoid misjudging a stock as under or overvalued. Always benchmark within the same industry. In cyclical businesses like auto parts or mining, earnings swing with the economy. A P/E of 8 at the bottom of the cycle might look like a bargain, but the company could be in a trough. Conversely, a P/E of 25 at the top might just reflect peak profits. Spot the cycle before calling value. One-time events, like selling a factory or writing off bad debt, can warp EPS for a quarter. If you don't strip those out, you might think a stock is dirt cheap or overpriced for the wrong reasons. Always dig into footnotes and earnings call commentary to spot these anomalies. When you screen stocks, use both trailing and forward P/E to get a range. Check how today's P/E stacks up against its 5-year average. Then, filter for names trading below their sector peers, but cross-check for any one-time losses. This balanced approach helps you find genuine value without falling into hidden traps. When you think of buying a business, market cap alone only tells part of the story. Enterprise value shows you the full takeover cost by adding net debt and other obligations. You'll use EV when you want a clear picture of what it really costs to acquire a company. To build EV, first calculate market cap by multiplying the share price by total shares. Then find net debt by subtracting cash from total interest-bearing debt. Don't forget to include preferred equity and minority interests. Those obligations belong to the buyer too. EBITDA strips out interest, taxes, depreciation, and amortization, letting you focus on pure operating profit. It's a handy proxy for cash flow because it removes non-cash charges that can mask true performance. EV/EBITDA levels the playing field across companies with different capital structures. By dividing total value by operating earnings, you compare apples to apples, regardless of how much debt or equity financing each firm uses. Here's a quick formula. EV equals market cap plus net debt plus preferred equity plus minority interest. Then take that EV and divide by trailing 12-month EBITDA. You'll find that published financials give you most of what you need. Just follow the steps. Some firms hide lease obligations off the balance sheet, especially under older accounting rules. Capitalizing operating leases by estimating the present value of future rent brings those liabilities into EV. Always adjust EBITDA too, adding back lease depreciation and interest. When you see minority interest on a balance sheet, it means the firm doesn't fully own a subsidiary. To match consolidated EBITDA, you must add that minority interest value into EV. Otherwise, you understate the total value supporting your valuation. Let's compare two peers. Company A trades at 8 times EV/EBITDA with low leverage, while Company B trades at 12 times but carries sizable leases. After capitalizing those leases, B's multiple drops to 10 times. That adjustment shows you B wasn't as expensive as it first appeared. You're about to build a DCF model, a tool that peels back market noise and shows what a company is truly worth based on its cash flow. Think of it as laying out future cash in a line, then asking what is that pile worth today. We'll break it into a detailed 3-year forecast and a terminal value for everything after, so you see both the journey and the destination. Start by pulling 3 to 5 years of income statements and cash flow data. You want a clear trend, not one-off spikes. If the company sold a building last year, strip out that gain. Cleaning your historical inputs means your projections won't ride on an unrealistic high or low. To forecast revenue, calculate the historical growth rate, then temper it with industry insights. If the sector is maturing, dial back growth. If the company just launched a new product line, you might boost it slightly, always explaining your assumptions. Better to be conservatively accurate than unrealistically hopeful. Next, model operating expenses as a fixed percentage of revenue, using your cleaned historical margins. For CapEx, separate the maintenance spending that keeps the lights on from big-ticket investments meant to drive growth. That prevents you from overestimating or underestimating cash outflows. Free cash flow is your star metric. Operating cash minus CapEx. It's the real cash a business generates for you, the investor. Project each year's FCF clearly in your spreadsheet. This stream of cash is what you'll discount back to today. Choosing a discount rate means calculating WACC. Combine the cost of equity, say, using CAPM, with the after-tax cost of debt based on current interest rates. If the company's risk profile is high, the WACC goes up and future cash is worth less today. That's a direct tie between risk and value. For terminal value, pick either perpetual growth or an exit multiple. If you believe the business can grow 2 to 3% forever, use the perpetual method. If you prefer market-based benchmarks, apply a sector P/FCF multiple. Always justify your choice with real-world comparables. Finally, discount each year's forecast and the terminal value back at your WACC. Add them up, divide by shares outstanding, and voila, you have the intrinsic share price. If the market price is lower, you might have a buying opportunity. And by running sensitivity tables, tweaking your growth rate or WACC, you'll see how your valuation holds up under different scenarios. Now let's discuss relative valuation screens. Think of these as a way to see if a stock is cheap or expensive compared to its peers. By using standardized multiples, you'll cut through thousands of listings and focus on a dozen or two candidates worth deeper analysis. Defining your peer group is critical. You'll group companies by the same industry and similar revenue drivers, using GCS or ICB sectors. And don't forget market cap bands. Comparing a $10 billion company to a $500 million one can skew your view. Next, pick the multiples that matter. PE works for most profitable firms. EV/EBITDA handles capital-intensive businesses better. Asset-heavy sectors like banks need price to book, while utilities may also demand yield filters. Tailor your metrics to each sector's DNA. To factor growth, use the PEG ratio, PE divided by expected earnings growth. If a stock trades at a PEG under 1.0, it might be undervalued after considering its growth runway. Just watch out for over-optimistic analyst forecasts that can make PEG look artificially attractive. Data cleanup is often overlooked. Drop any peer with negative earnings. Its PE makes no sense. Cap your screen values at, say, the 5th and 95th percentiles to mute wild outliers. And always cross-verify your data across two sources before trusting your results. You don't need $1 million terminal to screen effectively. Free sites like Finviz let you set basic multiple filters, while paid platforms unlock advanced sector breakdowns. If you're comfortable in Excel, you can build your own peer comparison model and refresh it weekly. When you build custom criteria, be explicit. Define cheap as P under 15 or EV/EBITDA under 8 based on a 5-year average. Layer on PEG or dividend filters to fine-tune. Save your screen settings, then backtest against past market cycles to see if they'd have worked. Then, interpret your picks with context. Look at your top and bottom quintiles for buying or shorting opportunities, but don't trade blind. Check the latest earnings revisions or sector news. Remember, screens narrow the field. Your own due diligence seals the deal. Think of ROIC as a report card on a company's capital usage. You'll learn how much profit it generates for every dollar invested. When you see a higher ROIC, you know the business is using its funds wisely, like a chef getting more flavor from the same ingredients. NOPAT strips away interest costs to focus purely on operations. Imagine you run a lemonade stand. You want to know how much cash you make after taxes, not how you finance your stand. That's NOPAT, clean, operation-only profit. To calculate NOPAT, start with EBIT, the operating earnings before interest and taxes. Then multiply by 1 minus the company's tax rate. If your hands-on example shows a 25% tax, you keep 75% of operating profits. Adjust for a one-time gain if the CEO sold a property last quarter. Invested capital is like the fuel you pour into your car. It's equity plus any debt you've taken on, your shareholders' money and bank loans. You exclude excess cash. Think of money sitting idle in your wallet. It's not fueling your operations. Add up shareholders' equity and all interest-bearing debt, then subtract extra cash that's not tied to running the business. A quick cross-check is total assets minus daily payables. The goal is to capture only the funds actively at work. Divide NOPAT by invested capital, and you get ROIC. If you earn $20 million on $200 million invested, that's a 10% ROIC. The benchmark is WACC. If your ROIC exceeds your cost of capital, you're delivering real value, not just breaking even. Remember, not all sectors are created equal. Utilities might show 5 to 7% ROIC, while top software firms hit 20% or more. By comparing within the same industry, say XLK for tech versus XLU for utilities, you see which companies stand out. When you're screening stocks, flag those with ROIC north of 10 to 15% consistently. Look for upward trends. If a company improves from 8% to 12% over a year, it's reinvesting smartly. Always pair ROIC with growth. A high ROIC on a shrinking business can be a red flag. When you hear economic moat, think of a medieval castle surrounded by water. That water keeps invaders out. In today's market, A company's moat is its edge, the thing that keeps competitors from stealing customers. By focusing on companies with wide moats, you can build a portfolio that weathers storms and delivers consistent returns. Network effects are the holy grail in tech. Imagine joining a social network with just a handful of friends. It's not very useful. But as your network grows, every new user makes the platform more valuable. Facebook and Amazon Prime are perfect examples. The more people join, the more compelling the service becomes, locking in users for the long haul. In utilities, it's all about red tape and price caps. You can't just set up an electric grid overnight or start piping water to thousands of homes without government nods. Regulators limit competition but guarantee a fair return. For you, that means exposure to companies that churn out reliable dividends with minimal risk of a newcomer undercutting them. Big box retailers and manufacturers win on costs. By ordering millions of units, they get suppliers to cut them special deals. They also build huge factories, spreading fixed costs over huge outputs, so their per item costs shrink. When a rival can't match those prices, you see a clear moat protecting the low-cost leader. SaaS companies embed their software in your daily operations. Think CRM platforms or accounting tools. Once your sales team's data lives there, switching to another provider means uprooting workflows and retraining staff. That hassle keeps you locked in, and companies monetize that stickiness with recurring contracts. Brands and patents are invisible walls. Coca-Cola's logo triggers instant recognition and justifies its price premium. On the other hand, pharmaceutical firms patent blockbuster drugs, legally blocking generics for 20 years. In both cases, intangibles create a moat you can't easily cross. Distribution giants like Walmart or FedEx have warehouses and logistics routes you can't replicate overnight. When they promise next-day delivery nationwide, smaller competitors simply can't match the speed or cost. That distribution network is a moat. Once built, it's extremely tough for newcomers to catch up. Let's compare two real examples. Company A scaled its user base from 10 to 40 million in 5 years, creating a self-reinforcing network moat that attracts advertisers and developers. Company B, a utility, leveraged regulatory barriers to deliver consistent earnings but couldn't grow fast. Each moat brings trade-offs, rapid growth versus stability. Understanding these helps you match investments to your goals. Intangible assets might sound abstract, but they're the engines powering a company's future profits. You'll often see patents, trademarks, and even goodwill on the balance sheet. These line items represent real competitive advantages that can last longer than any factory or piece of equipment. Don't let your screener skip over them. Think of a patent like a moat around a castle. It keeps rivals at bay and protects high margins. In pharma, blockbuster drugs live and die by patent life. You want to know how long that exclusive right endures, how broad it is, can other firms easily design around it, and whether the company is ready to defend it in court. There are 3 main ways to value patents. First, the cost approach adds up all R&D and legal fees. You get a floor, not the full story. Second, the market approach looks at comparable patent deals, but data can be scarce. Third, the income approach projects expected royalty streams and discounts them. Pick the method that fits your data availability and the patent's uniqueness. A trademark is your brand's passport. It tells customers who made the product. Iconic logos like Nike's swoosh or Apple's Apple justify premium pricing and slash marketing costs. Strong trademarks translate directly into brand equity, the invisible asset that keeps customers coming back, even when cheaper options exist. To measure brand equity, drill into customer surveys to see if people recognize and trust the brand. Then look at price premiums. Are customers willing to pay more? Stable market share over time suggests a solid defensive position. And don't forget Net Promoter Score. If your customers are raving about you, that's a green light for durability. Goodwill often raises eyebrows. It pops up when a company pays more for an acquisition than the fair value of net assets. Basically, you're paying for synergies and hidden advantages. Since goodwill isn't amortized like a patent, It stays on the books until something goes wrong. A big goodwill line item means they've been buying growth. Every year, companies must test goodwill for impairment. If future cash flows underperform, they write down goodwill, which slashes equity overnight. Watch for warning signs, declining revenues, shrinking margins, or optimistic discount rates in management's forecasts. Those can mask serious trouble. Let's bring this to life. In pharma, when a blockbuster patent expires, sales can plunge 80% in months. So your patent valuation must factor in that cliff. Luxury brands like Louis Vuitton sustain 30% price premiums because of brand mystique. And in tech, some firms pour 20% of revenue into R&D. That ratio can reveal hidden intangible investments. Always adjust your valuation multiples to capture these unseen assets. You've probably seen companies falter when leadership runs unchecked. Strong governance creates clear rules for decision-making and protects you from surprises. When you spot a company with robust governance, you can trade with confidence, knowing management is held accountable. Independent directors are your advocates at the table. They've got no family ties or golden parachutes awaiting them. By challenging the CEO on tough questions like risk and ethics, they help ensure decisions serve the company, not just insiders' interests. There are three main ways to value patents. First, the cost approach adds up all R&D and legal fees. You get a floor, not the full story. Second, the market approach looks at comparable patent deals, but data can be scarce. Third, the income approach projects expected royalty streams and discounts them. Pick the method that fits your data availability and the patent's uniqueness. Notice how some CEOs pocket massive option grants, even when performance lags? That's a red flag. Instead, see companies that tie pay to multi-year goals, like revenue growth or free cash flow. And when they include clawback clauses, you know they're serious about integrity. Dual-class shares can turbocharge growth by protecting visionary founders, but they can also lock out your voice. If you can't vote on big changes, you're along for the ride. Always weigh whether control perks are worth the governance trade-off. Poison pills might sound ominous, but they can secure better deals for shareholders if used sparingly. The key is whether they expire after a reasonable period. A sunset clause shows the board isn't just self-protecting, it's committed to fair play. When a company sells assets to insiders, you deserve to peek under the hood. Fairness opinions and third-party audits act as guardrails. If a deal pops up without clear disclosures, that's your cue to dig deeper or walk away. ESG isn't just buzz, it's a governance gauge. Companies rated high on board diversity and ethics programs tend to dodge scandals before they erupt. By tracking ESG scores over time, you'll spot teams that treat governance as a core strength, not an afterthought. Now, you'll see how a company's debt is layered. Think of each tranche like a rung on a ladder. Senior lenders get paid first, while subordinated note holders wait until everyone else is satisfied. Some debt is backed by specific assets, like real estate, while other loans rely solely on the company's promise to pay. Understanding these layers helps you gauge who's safest in a downturn. Next, map out when debt comes due. Bullet loans ask for one big payment at maturity. Imagine a mortgage with tiny monthly payments and one giant final bill. Amortizing debt, by contrast, paces out principal over time. If too many balloons fall due in the same year, refinancing markets might not cooperate, so you'll want to spot those lumpy maturity clusters. Balloon payments can sneak up like a ticking time bomb. A company might pay mostly interest and a bit of principal each quarter, then owe 80% of the loan all at once. If cash flow dries up, say sales slump, refinancing a big balloon can get expensive or impossible. Always calculate the balloon ratio. If it's over half the original loan, that's a red flag. Covenants are the guardrails lenders set. Affirmative covenants demand actions, like maintaining insurance, while negative covenants forbid steps, such as taking on more debt. Financial covenants hinge on ratios like debt/EBITDA, and event-based covenants trigger if the company sells a key asset. Know each type so you're ready when tests roll around. To spot covenant triggers, focus on ratio tests. Debt/EBITDA below 4 times or an interest coverage above 3 times might be required. When a quarterly report shows a breach, lenders can accelerate repayment or demand extra fees. For example, in 2019, a major retailer faced a costly waiver fee when its debt/EBITDA inched over the threshold, proof that small misses can carry big bills. Watch for refinancing risk when tranches bunch up. If a company has $500 million in debt maturing in Q2 2026 and another $400 million 2 quarters later, that back-to-back schedule spells pressure. Also check if one bond series dominates. Overconcentration means a single market hiccup slams most of the debt at once. Stagger maturities across years and lenders to avoid these pitfalls. Public filings are a goldmine for debt detectives. In the 10K, scroll to the notes to consolidated financials and find the debt schedule. There you'll see each tranche's terms and covenants spelled out. The management discussion often flags refinancing plans or upcoming balloon dates. A quick scan every quarter keeps you ahead of any looming cliff. Finally, set up simple but powerful monitoring. Plug maturity dates and covenant thresholds into your calendar so you never miss a test. A basic spreadsheet tracking principal outstanding, rates, and covenant ratios gives you a live picture of debt health. And don't forget to watch rating agency outlooks. When Moody's tweaks a rating, debt costs can shift overnight. With these steps, you'll stay informed and avoid nasty surprises. You'll often see a company that looks debt-light on the balance sheet, but you need to ask, what's hiding off sheet? These are obligations, like leases or joint venture debts, that live in the footnotes. If you overlook them, you'll underestimate the company's true financial risk. Think of off-balance sheet items as the financial promises a company has made, but didn't park on the main statement. Operating leases, for example, let firms use real estate without showing debt until you dig into footnote disclosures. The same goes for joint ventures, pension plans, and purchase guarantees. Why should you care? Because hidden liabilities can magically appear as real debt, dragging down equity and squeezing cash flow. If a rating agency spots them before you do, the stock can tumble. By analyzing these obligations now, you avoid surprises later. Don't skip the footnotes under commitments and contingencies. That's where the lease schedule's live. In MD&A, management often flags off-sheet exposures. And in exhibits, you'll find joint venture contract details. Make a habit of scanning these sections every quarter. To compare apples to apples, convert operating leases into capital lease debt. Discount those future lease payments back to today and tack that number onto the balance sheet. Then adjust EBITDA by adding back lease costs, so you see real cash generation. When evaluating joint ventures, treat them like mini companies you partially own. If your firm guarantees their debt, that's effectively your liability. Pull JV financials and calculate your share of obligations. It's the only way to forecast cash needs accurately. Company X looked solid until analysts uncovered $500 million in long-term leases hiding in the footnotes. Once capitalized, their leverage jumped from 1.2 times to 2.0 times, and their stock dropped sharply when they refinanced. Those who read the fine print sidestepped that decline. Before you value any firm, bake off-balance sheet debt into enterprise value. Normalize free cash flows by including lease outflows, then recalculate leverage ratios. By using these adjusted metrics, you'll make fairer comparisons and catch risks most investors miss. When you hear insider trading, think of the folks running the show, CEOs, board members, and anyone owning over 10% of shares. When they buy or sell stock and report it on time, that's perfectly legal. But if they act on secret info before it's public, that's a whole different ballgame, and the SEC won't hesitate to step in. Form 4 is your instant window into insider moves. Every purchase or sale by executives hits Edgar within 2 days. You'll see who traded, how many shares, and at what price. Scanning these filings each week can keep you ahead of shifting insider sentiment. Spotting insiders buying their own stock is like seeing the captain invest in his own ship. If multiple executives are buying large chunks, especially after a pullback, it usually means they believe shares are undervalued. Track insiders who consistently put their own money on the line. That confidence can be contagious. Insider sales can look scary at first, but they often come down to personal finance, tax bills, mortgages, or portfolio diversification. However, if you notice several insiders dumping large blocks all at once, and it's not part of a prearranged plan, that's a red flag worth digging into before you follow suit. Share buybacks are companies' way of saying, we think our stock is a bargain. They can buy in tiny amounts every day on the open market or launch a tender offer to scoop up a big block at a set premium. Either way, fewer shares outstanding mean each remaining share owns a slightly larger slice of profits. Not all buybacks are created equal. A company buying back 1% of its float each year is routine. But when you see a 5% or 10% program, it's a loud signal that management wants to prop up the stock. Just make sure they're not spending growth capital. Check the cash flow statement to confirm there's plenty left for operations. Watch the calendar. When buyback announcements land just before earnings, management often aims to steady the ship and avoid a price drop. You'll see a quick bump in share price and volume. That surge can be an opportunity for a fast trade, as long as you execute within the safe harbor window to avoid insider trading pitfalls. The magic happens when you overlay insider trades on top of buyback activity. If insiders are buying hand over fist while the company is aggressively repurchasing shares, that's your green light. But mixed signals, like insiders selling amid a big buyback, mean it's time to pause, investigate, and perhaps sit on the sidelines. Think of Moody's and S&P as the referees of corporate debt. They gather all the financial stats and qualitative insights, then hand out a grade on whether a company can pay back what it borrows. When they speak, markets listen, borrowers see their interest rates shift, and investors adjust their risk appetite. On Moody's scoreboard, AAA sits at the top, while S&P reserves AAA for its safest credits. Once you dip below BA3 or BBB-, you're in junk territory. And that means higher yields, but also higher default chances. Knowing exactly where a company stands helps you weigh yield versus risk. Both agencies crunch numbers like debt to EBITDA and interest coverage, but they don't stop there. They assess management quality, industry cycles, and legal risks. Think of it as a holistic health check. Strong blood work alone won't get you an A. You need a clean bill on every front. When you see a negative outlook or a watch list tag, don't wait for the downgrade. Prepare. These signals give you a heads up, often 6 to 24 months in advance. It's like spotting dark clouds on the horizon before the storm breaks. Treat rating triggers as your personal risk alarms. If XYZ crosses a leverage threshold, you can set a small stop loss or hedge with options. Conversely, if a company is slated for an upgrade, you might tiptoe in before everyone else rushes for the door. A downgrade often forces investment-grade funds to dump bonds, and equities can slump alongside credit spreads. Conversely, upgrades can spark rallies. Watch how bond spreads change. They often lead equities by days or even weeks. Your chance to jump in early. Don't let agency reports do all your thinking. Use their assumptions on growth and margins as a reality check against earnings calls in your own models. If Moody's pegs revenue at 5% growth, but management guides 8%, dive deeper before betting your portfolio. In Q1 2025, XYZ Corp's debt ballooned past 4x EBITDA, triggering Moody's downgrade cycle. Funds dumped $500 million in bonds, and the stock plunged 18%. But once spreads stabilized, patient investors saw a rebound. That's the power of watching ratings and knowing when to act. Today, you'll learn how quantitative screening turns a vast pool of U.S. stocks into a tight, focused watch list. By applying clear numerical criteria, you remove guesswork and stop emotional trades before they start. Let's get you set up for faster, smarter stock selection. Dividend aristocrats are your fortress in volatile markets. These S&P 500 names have raised payouts for at least 25 straight years. When you include them in your screening, you lock in companies that consistently generate cash and reward shareholders, even when the cycle turns south. Next, you'll split your universe into growth and value camps. Growth stocks are the fast runners, high revenue and earnings expansion. Value stocks trade cheaply relative to fundamentals. Using ratios like PE and PEG helps you blend both styles, so you're not overexposed if growth stalls or if beaten-down names finally rebound. The trusty PE ratio tells you how much you pay for a dollar of earnings. If you see a PE under 15, you might have an undervalued bargain. Above 25, you're buying growth expectations. By setting upper and lower PE bounds, you screen out extreme, cheap traps and frothy hype. PEG takes that PE and divides it by projected growth, giving you a fuller picture. A PEG around 1 means the price matches growth forecasts. Below 1 could flag undervalued growth gems. Just make sure those growth projections are realistic. For income-focused names, screen on dividend yield. A yield in the 2 to 3% sweet spot offers solid income without risking payout cuts. If you see yields north of 6%, dig deeper. Sometimes that's a sign management is struggling to maintain the dividend. Never forget financial health. A debt-to-equity ratio below 1.0 shows the company isn't overlevered. A current ratio above 1.5 signals it can cover short-term bills. And an ROE north of 10% proves it uses shareholder capital efficiently. Together, these filters guard against companies that look cheap but are on shaky ground. Finally, take your screen list, ideally 20 to 30 names, and do a quick qualitative pass. Read recent earnings commentary, news headlines, and industry developments. Set alerts for your key metrics and revisit your filters quarterly. With these steps, your watch list will stay tight, relevant, and prime for opportunity. Think of sector rotation like moving to where the party's happening. You don't hang out in an empty room. You go where growth and opportunity are strongest. In the stock market, this means shifting your money into sectors gaining momentum and away from those losing steam. Why bother rotating? Because sector strength often precedes the overall market. If you spot the winning group early, you can ride that wave before it becomes mainstream. And when you avoid laggards, you protect your gains during downturns. CAPE might sound technical, but it's simply a way to smooth out short-term profit swings by averaging 10 years of earnings. It flags when prices have run too far ahead of long-term earnings or when they're at rare bargains, guiding you on whether a market is pricey or cheap. Every sector has its own business cycle. By calculating a CAPE 4, say, energy or tech, you see which sectors are historically expensive or cheap. That tells you where to lean in or out. No guesswork, just relative valuation. You don't need to buy individual stocks to play sectors. ETFs like XLK for technology or XLE for energy package entire industries into one trade. Plus, watching where big institutions send their money via ETF flows gives you a sneak peek at rotation in action. To pinpoint a rotation signal, look for sectors whose ETFs are outperforming while their CAPE sits below average. Layer on moving average crossovers or yield spread indicators for timing. And don't ignore volume spikes. They hint that pros are piling into the move. Build your rotational watch list by ranking all U.S. sectors on CAPE deviations. Pick the 2 cheapest sectors showing strong ETF momentum. Then set alerts on moving average breaks. Revisit it every quarter because economic tides change, and so should your targets. Here's a real-world example. In late 2023, tech's CAPE dipped below its 10-year mean, while energy shot through the roof. If you had swapped part of your portfolio from XLE into XLK, you'd have captured a 15% outperformance in 3 months. That's rotation working in your favor. Think of fundamental triggers as your financial guardrails. By defining clear criteria, like valuation multiples or margin levels, you automate opportunity spotting and remove emotional guesswork. This way, you only see stocks that truly match your standards, rather than chasing every headline. A price target trigger tells you exactly when a stock reaches the valuation you vetted. If you decide 15 times forward earnings is fair for a tech name, set that as your alert. When a stock hits that level, you'll know it's time to review your position, not guess whether it's expensive or cheap. Earning surprises are high-impact events. If a company reports 5% above expectations, that's often when prices pop. Conversely, a miss can signal trouble ahead. By setting your trigger at around plus or minus 5%, you catch meaningful beats or warnings without getting whipsawed by normal seasonality. Margins tell you if management is running the business efficiently. If operating margins slip below, say, 15%, you want to know why? Maybe rising costs or lost pricing power. When margins climb above 25%, that's a green flag for strong execution. A simple margin trigger keeps you on top of these shifts. Single triggers can mislead. An EPS beat alone might not hold if margins are shrinking. By layering triggers, earnings surprise, margin improvement, and a price target, you only focus on the highest conviction setups. This multi-trigger approach filters out noise and directs your attention to the best ideas. Don't wait at your desk staring at charts. Link your watch list to a screener that sends you real-time alerts via email or SMS. Make sure it's tied to both price and earnings calendars. That way, when your trigger fires, you can move fast. No manual checking required. Triggers aren't set and forget. Every quarter, revisit your thresholds, adjust price targets after big sector moves, and tighten margin levels in choppy industries. Keep a log of these tweaks so you can track which settings deliver the best results over time. Let's look at Acme Corporation. They set a price trigger at $50 based on 18 times forward EPS, an earnings trigger for a plus 7% surprise, and a 20% margin threshold. All three criteria hit within a 6-week window, and the stock rallied 15%. That's how disciplined triggers turn into real profits.